Why real estate is the worst investment, Warren Buffett. Warren Buffett's long-term investment strategy has proven successful in virtually every market condition over the last several decades, including recession, high inflation, and deflation. Moreover, Buffett's dedication to his strategy has made him one of the most successful investors in history. Various new investment techniques and algorithms have come and gone. Still, Buffett has stuck to his relatively simple strategy of selecting strong companies and focusing on long-term growth while ignoring the noise that causes most investors to panic. It may appear strange that someone with such a disciplined long-term approach to investing hasn't purchased real estate besides a 40-acre farm and his personal residence, especially since Berkshire Hathaway Vice Chairman Charlie Munger made his fortune in real estate. However, today's video shows you what Buffett thinks of real estate and considers it the worst investment. Watch till the end and here we begin. Buffett is not opposed to real estate investing and has invested in several real estate investment trusts over the years. He understands, however, that becoming a landlord makes little sense. Purchasing and managing real estate is more of a business than an investment. Buffett understands that his time is better spent selecting companies to invest in than running a real estate business. Real estate is a tricky business that often requires several properties to be scaled to build significant wealth. Unfortunately, many individual investors enter real estate under the impression that it is a passive investment and most eventually exit those properties once they realize what they have gotten into. Real estate investing is a different story. Passive real estate investments enable investors to reap the benefits of this profitable asset class without managing it. For example, in total returns, the FTSE Nareit All Equity REITs index has outperformed the S&P 500 13 times in the last 20 years, with an average total annual return of 13.1% versus 11.1% for the S&P 500. On average, many investors who have turned to private markets for passive real estate investments have seen even higher returns. For example, since 2014, the real estate crowdfunding platform Realty Mogul has generated an average internal rate of return of 17.2% for investors on fully realized deals. Passive investors can purchase shares of individual rental properties for as little as $100. Since its inception last year, the Jeff Bezos-backed real estate investment platform has fully funded over 150 rental properties worth more than $60 million. Buying and managing real estate is profitable, but it's important to remember that it's a business, not a passive investment. The return on investment in real estate are a direct result of the time, energy, and money invested. But unfortunately, while that business has produced many great fortunes over the years, it is not a business that most people can afford. So, why is real estate investment not worth it? No diversification. Because real estate consumes most of a middle-class person's salary, it consumes most of their portfolio. So instead of having a balanced portfolio that protects investors in the event of a downturn, most middle-class savings are invested in the housing market. This is why the entire economy imploded when the housing market crashed in 2008. Leverage. Real estate purchases are typically leveraged, as previously stated. This means that people are paying significant amounts of money in interest. These payments are based on the expectations that real estate prices will rise. The issue is that investors risk losing a lot of money if prices do not rise. It should be noted that the price can stay the same for investors to lose money, even if the price remains stable. Investors have already lost a significant portions of their savings, which they had paid out in interest. Employability. Purchasing real estate forces a person to settle in a specific geographical area. Real estate can only be bought occasionally due to the transaction costs. The disadvantage of settling in one geographical area is that your options are severely limited. This is why millennials have chosen not to purchase a home. Owning a home is more of a liability than an asset in this day and age of layoffs and job changes, low returns, and high expenses. Real estate investments are notorious for yielding low returns. Historically, real estate investment returns have been less than the inflation rate. Only in recent years has a sudden increase in the capital appreciation earned on real estate. Unfortunately, the rental income is also insignificant. Furthermore, a significant amount of time, money, and effort must be invested to earn rent. It is frequently difficult to rent out houses. As a result, there is some risk involved. Even though many risks must be taken, the returns on real estate are comparable to risk-free investments. This is what makes real estate a bad investment for the middle class. Transaction costs. Real estate transactions are also unusually expensive. To begin, the government must be given a large sum each time a sale occurs. There are also costs involved in every estate transaction, such as legal fees, brokerage fees, and appraisal fees. As a result, roughly 10% of the value is lost each time a transaction occurs due to transaction costs. This also contributes to the previously mentioned illiquidity. However, because transaction costs are so high, buyers are stuck with the property they purchase, even if it turns out to be a mistake. Opaque. The real estate market is both illiquid and opaque. The listed prices of stocks, bonds, and other securities are the same as the transaction prices. In the case of real estate, however, the listed prices differ greatly from the rates at which transactions take place. As a result, a buyer's ability to determine the correct purchase price is extremely difficult. If buyers and sellers are not cautious, they can be taken advantage of by unscrupulous middlemen. Illiquid. Investments are useful because they can be quickly sold when needed. Take the example of stocks and bonds. These investments have a ready market and can be exchanged for cash in minutes. Real estate is most likely the only illiquid investment in the portfolios of middle-class people. In all markets, selling real estate is difficult. During downturns, it becomes even more difficult, with sellers frequently having to wait 6 months to a year before receiving cash instead of their property. What do you think of real estate investment? Let us know in the comments below.